If you've ever walked into a Canadian bank looking for a business loan and left empty-handed, or felt like the terms didn't make sense for a business at your stage, you're not alone. The banks are conservative by design, but there are government-backed programs built specifically to bridge that gap. And most Canadian business owners either don't know they exist or don't fully understand how they work. In Canada, there isn't one single program the way Americans have the SBA. What we have is a suite of tools, each designed for a different type of borrower, a different stage of business, and a different financing need. The three you need to know are the Canada Small Business Financing Program, the Business Development Bank of Canada, and Export Development Canada. Each one operates differently, and understanding the distinction is the first step to using the system properly. Let's start with the Canada Small Business Financing Program, commonly called the CSBFP. This is the closest Canadian equivalent to what Americans call an SBA loan, and it works on the same principle. The federal government, through Innovation, Science, and Economic Development Canada, doesn't lend you money directly. Instead, it shares the risk with your lender. If you default, the government covers a significant portion of the loss. That guarantee is what makes lenders willing to extend financing they'd otherwise decline. The CSBFP is available through virtually every major bank and credit union in Canada. You don't apply to the government, you apply through your lender, and they administer the program. The government's role is mostly invisible to you as the borrower, which is one reason so many business owners don't even know this program exists. The CSBFP has specific rules about what it can and cannot finance. It's not a general-purpose working capital tool. It's designed for three categories: real property, meaning land and buildings, leasehold improvements, and equipment. If you're buying commercial real estate for your business, fitting out a space, or purchasing major equipment, the CSBFP is designed for exactly that. Maximum loan amount is $1 million, with up to $500,000 allocated toward equipment and leaseholds, and the full $1 million available for real property. Repayment terms run up to 15 years for equipment and leaseholds, and up to 25 years for real property. Interest rates are regulated. They can't exceed the lender's prime rate plus 3% for floating rate loans, or the residential mortgage rate plus 3% for fixed. For small business financing, those are competitive terms. There is a registration fee, currently 2% of the loan amount, which gets paid to the government and can be financed into the loan itself. The program is available to businesses with gross annual revenues under $10 million. Startups are eligible. You don't need years of operating history to apply. That's a meaningful distinction from conventional bank financing. The CSBFP won't cover working capital, inventory, goodwill in an acquisition, or franchise fees. If that's what you need, you'll need a different tool. That brings us to the Business Development Bank of Canada, the BDC. The BDC is a federal crown corporation, which means it's a government-owned bank whose entire mandate is to support Canadian entrepreneurs. Unlike the CSBFP, the BDC is a direct lender. You borrow from the BDC itself, not through a commercial bank. This distinction matters for a few reasons. The BDC is not competing with chartered banks for the same customers. It's deliberately designed to go where the banks won't: earlier stage, higher risk, more complex situations. If a bank has turned you down, the BDC is often the next call worth making. The BDC offers term loans for equipment and business assets, commercial real estate financing, working capital loans, acquisition financing, venture capital for high-growth companies, and subordinated financing, which is essentially a form of flexible debt that sits between senior secured debt and equity. That subordinated financing product is particularly useful for businesses that have already maximized their conventional borrowing capacity but aren't ready for an equity raise. BDC loans typically carry slightly higher interest rates than chartered bank financing. That's the trade-off for the flexibility and risk appetite. But for businesses that can't access bank financing at all, or that need a structure a bank won't offer, the cost difference is often immaterial compared to the value of getting the deal done. The BDC also provides advisory services, consulting support on growth planning, financial management, and operational improvement. For some business owners, that support is as valuable as the capital itself. The third institution worth knowing is Export Development Canada, EDC. EDC is also a Crown corporation, and its focus is narrower. It supports Canadian businesses that sell to international markets or are looking to expand beyond Canada. If you're exporting goods or services, pursuing international contracts, or doing business with foreign buyers, EDC has tools that commercial banks simply don't offer. EDC provides financing, insurance, and guarantees. Their accounts receivable insurance protects you if a foreign buyer doesn't pay. Their bonding products help you satisfy performance and bid bond requirements on international contracts. And their financing can support foreign buyers who want to purchase Canadian goods or services, making your offer more competitive in markets where buyer financing is a barrier to closing a deal. EDC is not for every business. If you operate entirely within Canada, it's not relevant to you. But for exporters, it's an often overlooked source of support that can meaningfully reduce risk and expand what's financeable. Now, what does it actually take to qualify? Each program has its own criteria, but across the board, lenders and Crown corporations are evaluating the same fundamentals. They want to see that the business generates real revenue, that cash flow is sufficient to service the debt, that the owner has equity at stake, and that there's a credible plan for how the capital will be used. For the CSBFP, the eligibility rules are relatively accessible. Gross revenues under $10 million operating for profit in Canada with an eligible use of proceeds. Credit score matters, but it's not the only factor. The government guarantee changes the risk calculus for the lender. For the BDC, they're looking at the quality of the business, the experience of the management team, and the viability of the plan. They're willing to take on complexity, but they're not a lender of last resort. They want to back businesses with a credible path forward. In all cases, be prepared with financial statements, tax returns, a clear explanation of what you're financing and why, and some form of business plan or executive summary. The more prepared you are, the faster the process moves. A few things worth knowing before you engage any of these programs. Personal guarantees are common across all government-backed and Crown corporation lending. If you own a meaningful share of the business, expect to be asked to stand behind the debt personally. The CSBFP, while accessible, still runs through your commercial bank, which means the bank's internal credit appetite matters. Even with the government guarantee, some lenders are more active in the program than others. If one lender passes, try another. BDC and chartered bank financing are not mutually exclusive. BDC will sometimes co-lend alongside a bank. The bank takes the senior secured position on conventional assets, and BDC provides subordinated or supplementary financing. Knowing how to structure that stack is where an experienced advisor adds real value. And finally, provincial programs exist across the country. From Ontario's small business initiatives to Alberta's financing programs to the various regional development agencies. The federal programs are the foundation, but depending on your industry and province, there may be additional tools layered on top. Government-backed business financing in Canada is not the easiest system to navigate on your own. The programs exist, the capital is there, and the terms are often better than anything available in the conventional market. But knowing which program fits your situation, how to structure the request, and how to position your business to a lender, that's where most borrowers get stuck. Understand the tools available to you, know what you qualify for, and when you're ready to move, come prepared. That's government-backed small business financing in Canada explained. Subscribe for more. We break down the Canadian capital markets in plain language every week. If you're a business owner looking for financing and you're not sure where to start, that's exactly what we do at Equus Capital Finance. We help you understand your options, structure your request properly, and connect you with the right capital sources. Reach out at equusfinance.com.